Welcome everyone. Welcome to this episode of Market Wrap. I have with me Mr. Pankaj Pandey, and what an exciting week we had. After 5 weeks, I think we finally saw some green. Sir, what is the outlook on the market right now? Let's start from the top, and then we'll go towards the rest of the news that happened this week, from inflation to covering what happened in sector-wise. But first, let's talk about the market outlook.
Yeah, hi, good evening, Vishu. Yes, you're right. After 6 weeks of continuous sort of a decline and markets being oversold, markets inched up about 1%. And again, boosted by the fact that we've got lowest inflation print in last 8 years. The mutual fund inflows or the domestic flows have been pretty robust. Sectorally, we've seen pharma doing well, auto doing well, PSU Bank after SBI numbers did witness good amount of rebound. So some relief domestically, but globally markets are doing a lot more better. So S&P has already sort of made a new high. Again, on the expectation of a lower inflation print and also the expectation that the Fed is going to cut rates. Whether that happens by 25 or 50 bips remains to be seen. But yes, it's a technical pullback in the market, what we have seen amid oversold condition. Level-wise, I think markets have been able to hold on to 24,500 kind of a levels. And see, tomorrow you have a very important development. So you have Trump and Putin meeting. So in case something positive comes out, then it is possible that we could have a relief rally towards 25,000 kind of a levels. Otherwise, 24,200 as a support, and again 25,000 kind of a level on a higher side is what one should expect in the market. Otherwise, you really do not have much of a trigger. We have already sort of almost concluded the earnings season.
Absolutely. Sir, let's talk about inflation. It has finally come in around 1.55%, which is pretty low in quite a few years. What do you think about it from here on?
It's a 8-year record, Vishu. We had these kind of inflation in 2017. So 1.55 is definitely one of the lowest inflation we have seen. But I think a lot of this has to do with the decline what we have seen in some of the vegetables, pulses, cereals also are sort of quite muted. So a lot of these agri commodities have witnessed lower inflation because last year prices were higher. Now the prices have cooled off. So which is why you're seeing this kind of inflation. But nonetheless, even the core inflation has sort of come down to 4.1 odd percent from 4.4. So again, base effect is also sort of catching up there. And even in this inflation, we all know that gold has done very well. So since that 60 bips is contributed by gold. Now, while low inflation is a good thing, but it is not really sort of exciting the markets because see, RBI has already sort of lowered the inflation for this year at, say, for Q4, they have done it at about 3.1. But for next year onwards, they have increased or their projection is about 4.4%. So from that perspective, largely what will come out is that this low base will act as a from those levels, it is not expected the prices will decline. So prices are expected to sort of normalize. So somewhere down the line, the inflation will be higher, and which is why in India, expectation of a rate cut is not building up so much. But nonetheless, I think this inflation number is definitely quite soothing. Overall, GDP numbers have been sort of maintained. So yes, this is structurally good news, and then if you are able to sort of have a steady bout of low inflation, good growth, then I think we are our macroeconomic picture is getting a lot more better. So which has never been the case earlier.
Right, so fingers crossed we stay here at 1.55 itself. Sir, talking about the market fall that happened in the last month, it's always interesting to look at the mutual fund numbers and how the retail investors have been reacting to this market falls, market correction. What did the July picture say?
So picture says things are pretty solid. So total inflows in the month of July was at some 42,000 odd, so which is a lifetime high. In a month before, this was about 23,600 levels. Now, a lot of things are happened. So one is you had inflows from NFO. So if I sort of strip that out, inflows was still quite good at third highest number at 33,700 crores. When you sort of look at even the SIP numbers month on month used to witness an increase of about 500 odd crores, but this time the rise has been about 1,200 odd crores. So that way, that is also pretty good. I think when you sort of look at in NFOs, after some time, we are seeing sectoral funds being launched, and which is why we've seen good amount of inflows. The good part also is that the overall redemptions have been a lot more lower, and which is why this net inflow number has come out to very positive. Now, when you sort of look at large cap, mid cap, or small cap wise, I think small caps are clearly sort of doing a lot better. 5,400 crore kind of inflow versus 4,000. Mid cap slightly lower at 5,200. Sadly, we don't see much of an inflow in the large caps. And flexi cap is another where we have seen a good inflow of 7,650 versus 5,600. So large caps is something where people are still not looking to sort of chase or allocate more. But mid cap, small cap, and flexi cap, where you can invest in large cap, mid cap, and small cap across, and sectoral funds. I think clearly the inflows are pretty robust. And given the fact that FIs have been sort of selling, this kind of inflow is definitely a booster or a big booster in terms of confidence. Hopefully, I'm keeping my fingers crossed that this kind of FI selling market will be able to absorb in a far more better way. And in case if US goes for a rate cut, it is possible that some kind of inflow might happen, and that might benefit even large caps. So we will have both domestic plus FPI flows turning positive. But at this time, currently, mutual fund flows are definitely sort of holding the market very well.
Right. And let's hope FIs come back, like you said, and we all who have invested, this actually dips. This dip brings us some wealth. Sir, moving on, the Nifty picture that emerges out of this Q1 results. This is the earnings season is almost at a close. What does the Nifty picture emerge like?
So, Vishu, we are maintaining our Nifty target of 27,000. So, we were expecting earning growth of 8% this year and about 15% growth in FY27. Now, in this particular quarter, we've seen top line growing by 6 odd percent and bottom line growing by closer to 7 odd percent. Now, financials, which is a big chunk, I think that is where the growth has been slightly muted. Largely because one needs to understand that IndusInd Bank has been impacted. So you're not what you're seeing in IndusInd Bank is again not the kind of normal numbers you would expect in a normal scenario. So which is why when you sort of in financials, if you sort of exclude IndusInd Bank number, the profit growth is about 8 odd percent. So our sense is that overall earnings are in line with the expectation, but yes, you can always complain that the numbers are not so good for it to sort of lift the market. That is also correct. And somewhere along the line, I think second half is where we would expect some of the key sectors like banking sort of doing the heavy lifting in terms of earnings. Sectorally, I think capital goods, telecom, oil and gas did sort of well. I think commodity players have also sort of come out with good set of numbers. So we are maintaining our Nifty EPS of 1,060 for FY26 and 1,225 for FY27, and which is why we are maintaining our target of 27,000. So it's a sort of a 10% kind of an upside from current levels, and we have valued Nifty at about 22 times on FY27 basis. So all things okay from the earnings front, at least in Nifty.
Right, sir. Getting a little sector specific, we have been bullish on defense for a while. The ICICI Direct Research team has been bullish on defense for a while. We also discussed in the last few episodes how we have been getting new contracts in defense from the government. Sir, how did the results for Q1 for defense were? How was the picture in defense?
So some of the companies I'll highlight for you, Vishu. So for example, HCL, which is the biggest of the company, reported a revenue growth of 11%. Their margins are at about 27%. In a normal scenario, we would expect them to sort of clock margins of 30%. Now, this current quarter number is not really reflective of the capability or the kind of things which will unfold, largely because the company has started getting engines for Tejas Mark 1A. and it's already sitting on order backlog of about 1.89 lakh crore, and then there is a good chance of Tejas Mark to order also, and which is why I feel that a lot of numbers will start moving from next quarter onwards as and when the scale up happens, and which is why I feel that it's a good buy at current levels, valuation wise not so expensive compared to the rest of the pack. Then you have Astra Microwave came out with a pretty good set of numbers. Now it's a private entity, 29% kind of a growth. And again, company did quite well. So order book is healthy at about 2,200 odd crores. Pipeline also looks quite healthy. And company has guided for 20% kind of a growth. So from that perspective, this is another company which we like. Bharat Dynamics, after a lot of flip-flops, reported strong growth of 30 odd percent. Order backlog is somewhere about 23,000 odd crores. The company is expecting in the next 2 years an order of about 15 to 20,000 worth of crores. And mind you, this 23,000 kind of order inflow is 6 times the current revenue. So obviously they have enough visibility on their plate. Now, Cochin Shipyard also numbers came out with good 39% kind of a growth, again anchored by the ship repair segment, which is a better margin segment. It's an annuity kind of a model because every large ship requires minor repair every 2 3 years, major repairs in 5 6 years. So that becomes a sort of a stable revenue stream. On the shipbuilding side, company has been witnessing a degrowth, and our sense is that with the kind of order inflows what they have of 21,000 odd crores, that segment should witness better execution. And that is why overall, I think things should pick up for this company. And they are also sort of doing good things on the commercial side. So I think this company also holds a good amount of potential. And Midhani numbers were muted, 4% growth, but good part is that the company is still guiding for 20% kind of a growth for this year. So which is why we are still keeping a buy there. So all in all, most of the defense stocks have come out with a decent set of numbers. Probably only sector where you can witness double-digit kind of a growth. And given the way that acceptance of necessity has given to about 11.5 lakh crore worth of projects, next 2 3 years the order inflows could be in the range of 8 to 9 lakh crore. So that will not be a big surprise. So any kind of a major correction in these stocks is a sort of a buying opportunity. So from that perspective, defense continues to sort of do very well.
Absolutely. Two more sectors which are somewhat niche, not so common in investors' portfolio, but I want to ask about is hospital sector and plastic pipes. How were the results?
So we've already seen that Apollo hospitals are coming out with fabulous set of numbers, stock doing or touching new highs. Now, when I sort of look at the combined picture, so whatever hospitals we track, revenue growth has been about 12 odd percent. EBITDA growth is far more better at 26% because as the hospital matures, the typical margin profile improves for that stock. I mean, just to sort of give you an example, for a company like HCG, which is what we've been recommending for a good period of time, I think one of their older hospitals, the EBITDA margin is somewhere about 30 odd percent, whereas on a consolidated basis, the margin profile is somewhere about 17, 18 odd percent. So that is what the mature hospitals do to your business. And so from that perspective, numbers have come out with good. I think what you're clearly seeing is again the proportion of private insurance has sort of gone up. And also, what we're clearly seeing is that the complex surgeries have increased from say to about 25% compared to 15% last year. And most of these companies have witnessed good ROE expansion. Companies are expanding capacities by nearly 45% in the next 2 3 years. So we have enough expansion also on the plate. So I think this is one sector which we feel that of the consumption basket, besides hotels, is expected to do very well structurally. Again, topics would be Narayana because Narayana has witnessed some bit of a correction. SCG is another stock. We have recently come out with a report on Rainbow Hospital, which is a hospital dedicated for children. And last but not the least, Apollo again came out with a pretty good set of numbers. So that's also a buy with a target price of 8,960. So nearly 9,000 levels.
Right. And sir, what about the plastic pipes?
So, Vishu, we have been highlighting that we are not expecting great set of numbers from the plastic piping segment. Most of the companies came out with a weak Q1. In fact, demand was affected in this particular quarter, and raw material pricing also sort of impacted. Early onset of monsoon, weak housing demand, and obviously lower government spend impacted the demand. So again, volume growth for Supreme was better at 5.7, and Astral flattish volume growth. In fact, the PVC prices have corrected by 10 odd percent, and that sort of led to lower realization and also led to inventory losses. And which is why we have seen EBITDA margin contraction for both the companies. And profit we have seen declining by 26% for Supreme and 33% for Astral. Now, despite these weak prices, we are still, or we are very positive on the sector because, again, Q2 is something we are not expecting to see much of a rebound because, again, it's a monsoon season. In monsoon season, typically you don't see much of activity happens. It is the second half we are a lot more bullish on, and that is where we would expect numbers to improve. And while the PVC prices have increased by 3 odd percent, I think where we are sort of taking or deriving our confidence is that Supreme Industry has guided for a volume growth of 15 to 17%. Earlier, their guidance was 10 to 12 odd percent, and Astral has retained a double-digit volume growth. And mind you, both these stocks have witnessed a decent amount of correction. So from that perspective, I think these kind of correction in the stock is a sort of a buying opportunity, and which is why we have a buy rating on both these stocks.
Right, right, sir. So we have discussed, I think, majority of the large cap banks already and their results. SBI is the only one that has just come out. What did the numbers say?
So SBI again very healthy set of numbers. Credit growth has been maintained at about 11.6 odd percent. Deposit growth also on similar lines. Again, largely driven by term deposits, and asset quality again stayed sort of robust. The only thing is that we are seeing sequential pressure on margins, so 20 bips, kind of a decline in NIMs at 3.0%, and that has kept the NI sort of flat. It is the treasury gains and the other fee income which sort of led to the better performance. Otherwise, most of the numbers were sort of steady, and companies also guiding, or bank is guiding for steady set of growth, also 11 to 13% kind of a CAGR. And then I think what they're looking at is an NIM of about 3 odd percent, ROA is at 1%. Where we are also sort of looking at is that the recent fundraise has attracted good amount of investor interest, and which is why I feel that this stock is one of the few good stocks in the large cap BFSI space. And there we have and in this stock we have a target price of 940. So we are valuing the bank at about 1.1 time adjusted book, and 275 for the subsidiaries it carries. So good set of numbers. SBI within PSU banks have always been delivering very steady set of numbers.
And coming to finally the hidden gem of the week, which will it be this time?
So Vishu, given the global volatility, I'll want to sort of recommend a domestic oriented theme. So hotel and hospital I've been liking for some time. So within hotel, I'm recommending ITC Hotel. Now, this is the second largest player domestically. See, the industry setup remains pretty good. We are expecting 8 to 9% kind of a demand growth, whereas the supply at best is not going to exceed 5%, which means that ARRs are going to remain at elevated levels along with occupancies. Last quarter also, this company came out with good set of numbers, about 15% kind of a top line growth. Domestic growth was about 14.5%. Now, this growth would have been better, but for the month of May when we had this India-Pakistan conflict. So from that perspective, numbers would have been even more better. Now, on the occupancy side, occupancies have improved to 73%, but compared to peers, it has still a lot more scope to sort of go up to 75, 78 odd percent, which is what we would expect to sort of happen over a period of time. On the debt side, no major challenges. They're sitting on a pretty strong cash of nearly about 1750 odd crores. Overall sense is that with better industry tailwind, we would expect ARRs to sort of grow in double digits. And accordingly, our sense is that the revenue will grow at 15 odd percent and bottom line will grow at nearly 30 odd percent. And which is why I'm liking this entire space and ITC hotels in particular with a target price of 282.
That's great to hear, sir. Well, that was it for this time. Thank you so much, everyone, for listening to us. And thank you, Pankaj, sir, for your insights. If you have any questions, audience, you can put them down in the comments. We'll be back next week, same time. Thanks again.
Thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.